Hey, what's up, guys? So I'm actually going to try to cut through 2 or 3 slides here, just kind of talking about investing basics so that you can understand some of the terminologies that people use when investing or when talking about investing and different kinds of investing. That being said, I'm not going to insult your intelligence and read like verbatim through these definitions. I'm going to leave them on the screen, and then I'll make sure that my image is at the bottom and then moves up to the top so you can read through all of them as I chat. That being said, like a few important things. So a bond is usually more like a government-backed security. They used to be like way back in like the 70s, 80s. These were really good investments. They had good returns, but currently they don't. They're guaranteed by the government or by whoever is, the corporate bond, whatever. So defined period, defined interest rate. You know exactly what you're going to get on a return. That's pretty much how it works. Index fund is like a conglomerate of either like the entire S&P 500 or the entire stock market or the entire like different sections of the stock market. So it just pulls a conglomerate of different stocks into a pool. So by investing in an index fund, you could be investing in like a total stock market index, meaning like the entire economy, like every publicly traded stock, rather than just like having to choose individual companies. So I'm a huge fan of index funds. I think like that's where I would put my cash if it isn't going into real estate or like 401k. Mutual fund is, I guess, somewhat similar. They're handcrafted and then they're actively managed, so they're usually a little bit higher in fees. They can do very well, but you got to watch out for what the fees are because it can add up, which is why I'm a huge fan of index funds. Stock just signifies ownership of a company. Like I said, that's investing in, like, if you want to invest in Tesla specifically, there are some perks to that, but it was also more risky than just investing in an index fund. Crypto, right? This is something that's the blockchain and crypto tokens and everything. This is all still fairly new to the investing world. It's extremely volatile. There's definitely a place for it in your investment portfolio. I have, several $1,000. I mean, probably about 1% of my net worth. So, well, actually, I don't even know anymore. It's kind of grown. So it's at like $14,000, $15,000. But I just kind of gamble around with crypto here and there. So it's a decent part of my little portfolio, but super small, and it's very risky. So I use it to kind of, play around a little bit, but nothing crazy. Let's see. So traditional IRA is just an individual retirement fund. The traditional is where you pay the taxes on the back end. So you put pre-tax dollars in, and then afterwards you pull post-tax. So you pay the tax when you pull the money out. Roth IRA allows you to pay the taxes up front, and then those gains grow tax-free, so no capital gains tax, which is awesome. And then a 401k is just a retirement savings. It's an employee version of like the thrift savings plan, or the TSP is a 401k. So that's a Roth. There's a Roth TSP and a traditional TSP. I will quickly touch on the fact here that I think I mentioned this in the TSP section, but I just want to reiterate that if you think you're going to be in a higher tax bracket later in life, go with the Roth. And if you think you're going to be in a lower tax bracket later in life, go with the traditional. For most young service members or young people, the Roth is definitely the better way to go. All right, the velocity of money, right? So there's a couple things here. So time value of money, opportunity cost, velocity of money. So time value of money is how much will your money be worth in the future if you invest it. So that's thinking through like, man, I really want this $100 pair of sneakers today, but if I invested this $100, how much would it be worth, down the road? So, for example, if you put $100 into an index fund or whatever that earned an average of 7%, which is actually a little low right now for the market average, but let's just say 7%. By the time you're 60, that'll be $1,600. So by buying that pair of shoes, you're missing out on $1,600 later in retirement, right? So that's kind of the thought process here. So the more you realize like the time value of money and how much money you put into each other, which bleeds right into opportunity cost, because by realizing that, now you know that if you just invested that $100, you'd have $1,600. So that's why, like, the more you invest up front, the more you can enjoy life later on, right? And then the velocity of money is just how fast your money comes back to you and compounds. So, that's like saying, hey, I earned a 10% return on $100 over a year. That's great. It's $110. But if you earn that same 10% return over 1 month, and you could keep doing that, like, that's way better, because now you're earning 120%, but it's compounded 10 10 10 10 10 10 10. And so that first month you earn $10, the next month you earn $10.10 or whatever, and then you earn So it goes up exponentially. So, or it would actually be $11 the second month. And then, and so, yeah, those are very just important like mindsets around money. Like the more you invest early, the better off you'll be long term, and the faster you can get that money back in. So like a 3% return that's compounded monthly would blow a 20% return that's compounded annually out of the water, right? Meaning not saying like 3% annualized, but like a monthly 3% return. So if you put $1,000 in, you're in 3%, that's $1,030. And then you earn another 3%, that's $1,060 the next month. So it would very quickly outpace the 20% for the whole year because you're compounding it and it's coming back much faster, right? So that's kind of understanding the velocity of money. All right. And then this goes back into the compound interest, right? So 1,000%, here's a better draw out of how that math pans out. So it would be $1,000 at 10%, 1,100 after 1 year, 1,210 because then it earned. So what it did there is it then earned 10% on the 1,100. So that's $110. Now it's 1,210. Then after 3 years, it's 1,331. And after 10 years, it would be 2,594. And it would just keep going. So then by the time, after 10 years, now you earn 10%. Now you're earning $259.40 on that as a return that year, whereas the first year you only earned $100, right? So now you're earning more every year, and it starts to do that exponential climb. So compound interest is extremely powerful. It's just super valuable, right? So you want to understand compound interest for sure. And that's really all there is to it, right? The more your money compounds and the longer you invest over time consistently. This is why like days in market are more powerful and more important than, days like whatever. So like you don't want to play the like day trade game where you pull your money out, put it back in, pull your money back out, put it back in, you're paying all these fees and taxes, and it's not like just continually compounding. You want to just let your money roll, right? It's much more valuable. And that leads right into the, KISS investing. So this is going to be the last one I do here, and then I'm going to break it off for the rest of the investing basics, which will cover real estate. So this is kind of more on the index fund side. So dollar cost averaging. Now, dollar cost averaging is like what your TSP automatically does. This means that you buy the same amount every month, no matter the price. So this is a very safe and logical, not emotional way to invest in real estate. So this allows you to think through things and just like get to a point where you can really just fundamentally just consistently invest in the market without having to worry about what it's doing. So dollar cost averaging means that say you're investing $1,000 and the index fund that you're investing in is $100. So now you bought 10 shares. Well, the next month, say that jumped from $100 down to 50. Well, now you still put $1,000 in, so you just get 20 shares. But then when that fund goes up to $200 in 2 months, well, now you only get 5 shares, but it's at $200. So it just helps you, just continually buy $1,000 worth. It's just an easy way to invest rather than saying I'm going to buy 5 shares every month, and then some months is more, some months is left. You just want to put the same amount of money in. Definitely recommend investing long term rather than short term. If you trade things out short term, you're going to end up paying more in taxes, right? You're going to have tax implications. You're going to have more risk. Short term investing is just not the way to go in the stock market or really in anything. But short term capital gains is definitely a lot heftier than long term capital gains. I definitely recommend index funds over mutual funds because mutual funds have fees. They're actively managed. They trade more frequently. They're going to get hit with more fees and more costs. Whereas the index fund, it just stays. And it's going to be in that total stock market, and it'll change some stuff around, but their fees are usually much lower. And the TSP is effectively an index fund, right? So I love the thrift savings plan. Crypto, obviously, I'm not going to dig super deep in this, but just know that it's volatile and it should be a smaller section of your net worth that you're okay with losing, right? You can definitely win big with crypto. Also know that if you start hearing about a coin on like mainstream TikTok or Instagram or media, because it's like some hype coin, it's probably too late, right? Like Dogecoin, most people miss the bucket on that. I got into Dogecoin super early, but not because I heard about it on TikTok, but because I thought it was an interesting name and was like, oh, that's cool. I bet someone will think that's funny one day. Let me throw $200 at it. I bought it at like a third of a penny, and I sold it when I got up to like 8 cents, right? So I made a good chunk of change, and then invested that in a bunch of other speculatory crypto. I could have ridden it all the way up, but I don't like to ride the hype train, right? So hype investing is not really investing. It's super risky. It's gambling. So just know what it is, and know that you only put money in that you're willing to lose. And then individual stocks, there's something to be said for this. I've got an article or two on the website about like how to analyze stocks and securities and what companies might make sense to buy. Not a company breakdown, but like how to analyze that. I'm not a huge fan on individual stocks. Just, you never know. Like, prime example with Tesla back in the day, Elon Musk smoked a blunt and the stock dropped 9% the next day, right? So, like, who cares? The company did the same. But like with real estate, that's not the case. If your tenant smokes a blunt, like, your property's still worth the same amount of money, right? So it's kind of why I like that. And index fund is good because like that really would have just been a blip in the bucket compared to the rest of the fund, right? So that's my thoughts. These are some investing basics, some nomenclature, some terminology, and some different concepts, and then kind of some stock market stuff. So now we're going to dig into some real estate basics.